first quarter event, but it's actually our fourth quarter event from December when we had some ice fog here at the college. I didn't even know that was a thing, but it is. And now we're all here together right before a big snowstorm, so we're going to find out more about winter weather in about 12 hours. But it's good to see you all here today. Thank you so much for your commitment to your planning and being clients of our firms here at Elville Associates and law offices here at Greenwald. And I'd like to introduce a few people to you. Of course, we have Stephen Elville, who's our managing principal and lead attorney at Elville Associates, and Gary Greenwald, principal at the law offices of Gary Greenwald. We have three guests here from Elville Associates. Where did they all go? Oh, they're in the back. So Maria Van Buren, who is senior counsel with Elville Associates. Do you want to stand up and tell us your life story, Maria?
Oh, yeah, sure.
So, Maria Van Buren, Justin Ginsburg, who is a senior associate with Elville Associates. Thank you so much for being here today. And also in walks Brian Pugh, the hero of the hour, who went all the way to Columbia to get... Brian went all the way over to Columbia to rescue us and get a couple Keurigs at work after our initial one conked out on us this morning. So welcome to Brian, also a senior associate with Elville Associates. So thanks for being here today. A few housekeeping items. Obviously refreshments, food, water, coffee, tea in the back. Restrooms are out the door and to your left, and is your first left after that. And again, thanks for being here and breaking the coals. And if we know it's going to snow and it's going to be nasty weather, might as well just hunker down and enjoy it. So you're here for a great reason today, for further education and presentations from Steve and Gary. So just relax, enjoy, and then you get home and start a fire, something fun. So, all right, I'll turn it over to Steve.
Thank you, Jeff. Thank you so much. I'm so thrilled that everybody came out in this weather, so thank you so much. And for our three attorneys from our firm, thanks for coming out. I wanted to thank Jeff not only getting up at dark 30 and getting here like he always does, but I also wanted to thank Jeff because he said that he will snow blow anybody's driveway. He'll be at your house tomorrow morning, just let him know. All right. Now, I just returned from the Heckerling Conference in Florida, and that's the conference to be at if you're an estate planning attorney. So next quarter, or this quarter, when we do our first quarter meeting, we're going to talk about the Heckerling update, which we normally do. But I just wanted to spend a few minutes before we get into the main presentation. I just wanted to spend a few minutes just to give you a little bit of what was discussed. And I was talking to Justin this morning and Brian, and just telling them it was an amazingly powerful conference, and really got from the entire estate planning community, which is really kind of known now to be the epicenter of estate planning, which is the University of Miami Law School, believe it or not. And so this is where a lot of our thought ideas come from. But just to give you an example, and I'll be brief, situs and multi-jurisdictional practice. So you may remember from a few CCP meetings ago, we talked about how the world of estate planning is becoming more multi-jurisdictional and so forth. And as you continue to update your documents, you're going to see this more and more, that you have more and more options, more and more flexibility. Now, there's a downside to that, which is fiduciary duty can be seen to be eroding. So we want to, that's another reason to be updating our documents and find out what's going on in the world. So we have to be very specific. We talked about recent developments. We talked about the new world under OBA, the One Big Beautiful Bill Act. We talked about advanced partnership tax planning, which is not going to be applicable to most of us in this room. Charitable remainder trusts, for those of you who are not using donor advised funds, but you're going to be using a charitable remainder trust. There are a lot of real nuances on the back end of that, and there were a couple sessions on that. SLATs, spousal lifetime access trust, where you might someday distribute assets or contribute assets to a trust for your spouse and children. As the assets that you have continue to grow, as you might use your estate tax exemption someday in advance, these trusts are prolific across the country, and some of your children I know some of our children are doing maybe better than we did financially, sometimes not. But some of you have children who are wealthy and they're doing very well in their lives and careers, and they need to know about these things. So SLATs, there's a lot going on there to talk about that. Restructuring interests in trusts. Some people have marital trusts or non-marital trusts that were established on the death of a spouse. And the question is, should those trusts, stay around? Should they stay around in the form that they are in? Should they be taxable in the surviving spouse's estate, or should they be taxable in a different way where they're just basically terminated? So there's a lot going on there about gift tax if we undo an existing trust. Divorce. There was a lot of talk about divorce, and I know many of you in this room are protecting your children and grandchildren from divorce in further trusts. So the statistics are that first marriages, about 42% end in divorce, 66% of second marriages end in divorce, and 73% of third marriages end in divorce. So divorce was a big topic at the Heckerling Conference. Not only about divorce itself, but for those of you who have asset protection trusts that you've created for your children, how those trusts are affected. For example, if there is a child of yours who's in charge of their own trust, and how that child might distribute assets out of that trust, and how we have to be concerned about what rights would a divorcing spouse have under those circumstances. Special needs planning. Not only new techniques. For example, those of you that have a special needs child or a special needs grandchild, the parent, whether that's you or your child, of that special needs child is doing a lot, right, to keep that situation going, to keep the caregiving going. So a job description might be something that you would create to provide to the future trustees, and other tools that were discussed. The other thing that was discussed, which Gary's going to get into a little bit more, is that a lot of families are depending on public benefits, and even if those public benefits are there, the infrastructure of those public benefits is fraying at the edges. And a lot of caregiving that we want to be there for special needs children in the future, even though they may be eligible for government benefits, the caregiving is not necessarily going to be high quality, and a lot of very low-paid caregivers that are not willing to work for those kinds of wages anymore. So a lot of families with loved ones with special needs are going to have to find new and creative ways to self-fund caregiving in the future. So that's going to be a big thing going into the future. Fiduciary duty, I mentioned, is changing. A lot of information about life insurance. Elder abuse, up to $40 billion of elder abuse is going on in this country yesterday. My own mother was almost scammed yesterday. I had to spend time with her last night because she was, kind of distraught because she had fallen victim, and I don't think she's lost any money, thank goodness, but she had fallen victim to a series of phone calls yesterday where someone had led her down a primrose path of downloading apps onto her phone. And those apps, once I looked at them, to my horror, those apps were apps where somebody could remote into a device. So you have to be very, very careful with not only yourself, but with your loved ones. Cybersecurity, and in the age of AI, so we're going to talk about that a little bit coming up. And also planning for retirement plan benefits. And then the one that sometimes is the most enjoyable topic at Heckerling is what we call the downright fascinating, curious, or odd fiduciary cases. So I'll just spend, as I segue now into my presentation, I'll just give you a little bit of a flavor. It's not funny, but when you listen to it, you can't help but laugh if you actually heard some of these cases. So, for example, where an executor seeks to sue, as he wants to sue, bring a lawsuit as the executor of the estate, well, it always helps to be the executor of the estate if you're going to do such a thing. So those are the kinds of cases we heard. If you are a beneficiary of a trust or will and you seek to sue, it always helps to actually be the beneficiary. So that is a problem. And then perhaps my favorite is the litigant who sued in federal court in 2025. And the litigant was admonished by the court, and to my surprise was not punished by the court, because the litigant made up not only They made up fake people with AI, and they made up fake cases that they brought before the judge. So the judge admonished the person and told them never to do it again. The person said fine. They've refiled in a different federal jurisdiction and made it the same cases or different cases. So you can't make this stuff up, as they say, but some people do. All right. So as we think about life insurance and life insurance trusts, and I appreciate your time and attention to this, you may be asking yourself, what are we doing talking about this topic? So we're going to talk about ILITs, irrevocable life insurance trusts, and why they matter, and why they may matter to your children or grandchildren. We're going to talk about, give it to my slides here. We're going to talk about how life insurance strengthens an estate plan. We're going to talk about the tax benefits of a life insurance trust. We're going to talk about how ILITs, or irrevocable life insurance trusts, protect families and beneficiaries. We're going to talk about special needs planning with ILITs, okay? And we're going to talk about liquidity, stability, and legacy tools that are brought to the forefront through life insurance trusts. And we're going to give some real-life examples. Now, I fully recognize that many people in this room, you've done great planning. You've done great financial planning. You've done great estate planning. You continue to do that. Many of you are just incredible with your financial wherewithal, your financial stability. So you may ask yourself, why would I even be curious about a life insurance trust? So I just ask the rhetorical questions because I'm not saying it does apply to everybody in this room, but I think it's a good idea to have this under your belt. So I'll just ask some silly questions. How many of you have investments? Have they gone up or down recently? Pretty much up, right? Okay. How many of you have retirement assets? Have those gone up or down? I know some of you can't spend it fast enough, right? Because it just keeps going up. So I'm really happy for you about that. But I would just argue, because of that, right, wealth is increasing in this country, right? And, you know, as we go to conferences as estate planners, I remember years ago, right, and you'll remember this, you know, when I was a young lawyer, if you had $1 million in your, quote, taxable estate, you had a significant estate, right? The Maryland estate tax exemption was $1 million. 4 years before I became an attorney, the Maryland estate tax exemption was $600,000. So now it's $15 million under OBA, right? And it's indexed for inflation. And the Maryland estate tax exemption is $5 million. So your wealth is increasing. The average middle America estate planning client is somewhere between $5 and $35 million. Does that surprise you? With a Dow at 49,000? Doesn't surprise, does it? So we have Maryland estate tax issues, we have potential federal estate tax issues, but now more down to earth, we have special needs planning purposes. We have children that you might have that are doing extremely well. They may have businesses, they may be creating wealth at an unprecedented pace. Above and beyond special needs planning, you may have a special purpose. How many of you, and we'll talk about this in the next session in 3 months from now, but how many of you know that you can have a special purpose trust? You can have a special purpose trust in Oregon that does not have to be a charitable trust. So there's all kinds of things that people are, you know, yesterday we did a webinar on love. You know, estate planning is about love. Estate planning is about love of who you love, or estate planning is about what you love. You know, so you might turbocharge a plan simply because you wanted to infuse money for a special purpose. And even if you are leaving lifetime trusts or trusts at death that are in perpetuity for children and grandchildren, you can actually turbocharge those trusts with life insurance. So there's a lot of reasons to talk about life insurance, and then of course today you'll take this under advisement and see if it applies to you at all. So let's talk about how this all actually looks. We're going to talk about life insurance design, trust design, how that actually works. We're going to keep the policy death benefit out of your taxable estate. So there's no sense in buying life insurance that Uncle Sam is going to tax at 40%, right? Or the state of Maryland is going to tax at 16%, right? So when you buy life insurance, if you do buy it, And how many of you, don't have to raise your hand, but just think about how many of you might have life insurance policies? And I know we have a financial advisor, at least one in the room. Hey Mark, how are you? And Mark and I have not talked, but Mark probably has certain views, which Mark, you're welcome to share, about life insurance. I know some financial advisors in today's world that will simply advise, get rid of all your life insurance. Just get rid of it, you don't need it. But I don't necessarily see it that way. Mark, do you have any thoughts about life insurance as a tool? I know I'm putting you on the spot, so you can think about it for a few minutes. Financial advisors are going to see this in different ways. But I'd like you to kind of think through the lens of, is there any purpose that I could see for life insurance? Or my children, should they be getting life insurance? Okay, so we want to keep the policy death benefit out of your estate. We want to ensure the family receives the full value without tax. I just mentioned that. And there's a trustee that manages the policy for long-term benefit. Okay. How many of you are very clear about what an irrevocable trust is versus a revocable trust? Are you guys pretty clear on that? So the way I think about it, just for those of you who might not be fully understanding this, a revocable trust, which I know many of you have, is a substitute for a will, right? That's all it is. It's a fancy will. And if it's done right, and if it's funded right, you're going to avoid probate. Probate at your death, probate at your spouse's death if you have revocable trust. Well, some people will say, what is an irrevocable trust? Well, of course, your revocable trust becomes irrevocable at your death. So that's one form of an irrevocable trust. Your children's trust that you create through your will or trust, they become irrevocable at your death. But this is a lifetime trust that you create, a irrevocable life insurance trust. It's an irrevocable trust during life. So if you haven't thought about this, I would encourage you to think about an irrevocable trust as a trust with a special purpose. It doesn't have to be a special needs trust, even though I met with a couple yesterday that I hadn't seen in 10 years, and they specifically wanted their child's special needs trust to be irrevocable and not revocable during life. So they created an irrevocable special needs trust. But generally speaking, an irrevocable trust, in my opinion, is a trust that's created with a special purpose in mind. And here, the special purpose is life insurance. So if you can imagine you've created a trust, and you are the grantor of that trust, and this trust owns the life insurance. So let's talk about that for a minute. We're going to get into more of the details. You purchased a life insurance policy, and I know some people in this room are more educated than others about life insurance. So life insurance, of course, is, we call it the Swiss Army knife of estate planning, because it can be used for lots of different purposes, and it's income tax free. But Uncle Sam counts it as part of your taxable estate. So if I met a young couple who's 28 years old, and they hardly have any assets, and they have young children, but the husband goes out and buys a $7 million life insurance policy, even if it's term insurance, that $7 million is part of his, quote, taxable estate. So we just have to recognize life insurance does count towards our taxable estate. Now, when we buy life insurance and we intend to put it in an irrevocable trust, we first start the process by buying the life insurance, but who actually buys it? It's actually going to be the trustee of the trust. So we're going to get into that. I want you to kind of visualize maybe a bubble, a circle, and that circle is the irrevocable life insurance trust. And so you establish that trust, and that trust has a trustee, right? And it has beneficiaries, and that trustee is now going to be the purchaser. So if you can imagine this, you kind of started the process, you have a life insurance connection with an agent, you start that process, but now, midstream in that process, you switch the purchaser because you're getting underwritten, you're seeing how much the cost is going to be for that life insurance. Now, midstream, the purchaser becomes the trustee of the trust. So I just want to get this in your mind. The life insurance policy is going to be started as the purchase process, but somewhere along the way, the trustee of the trust is going to be actually the purchaser of the life insurance. And the trust is going to own the life insurance. So imagine in that bubble, there is a policy in that bubble. And so the life insurance trust owns the policy, and at the death of obviously your death, the insured, the life insurance proceeds are paid inside that bubble. So it stays inside the silo or the bubble of that trust. So just imagine that you've bought a life insurance policy, the trustee technically purchased the policy, the policy is owned by the trust, and the beneficiary of the policy is the trust. So there's a grantor, there's a trust that owns that policy and is the beneficiary of the policy, and then there are beneficiaries. Now, Uncle Sam says, wait a minute, did you have any ownership at all of that policy? So that's why it's very important that in the middle there where it says the trustee manages the policy, it's also very important that the trustee is the trust is the owner of the policy. So Uncle Sam says if you have any incidents of ownership, you have any connection whatsoever with that policy, Uncle Sam is going to say that that is taxable in your estate. So we want to move a policy to the trust, and it's not part of your estate. All right, if you're confused, please raise your hand. All right, so just try to imagine a bubble or a silo that owns a life insurance policy. Okay, not you. It's on your life, but it's not owned by you. All right, so the grantor, which is you, gives money to pay the premiums. So imagine that bubble or that silo. Who was going to pay the insurance company for the first premium? Well, it's you. You're going to make a gift into that policy, or you're going to transfer funds, I should say, into that policy. And now the policy is purchased inside the trust. The trustee pays the premiums from inside the trust, okay? And again, the beneficiary of the policy is the trust. So this is going to sound funny, but just bear with me. So you have created a trust. You've gotten underwritten for life insurance. Midstream in the process, the trustee, who's probably your spouse, or if you're not married, it would be a third party. That trustee now is the purchaser, and they are going to purchase it within the trust. And whoops, my microphone just died. And let's see if it comes back on. Okay. Thank you, Gary. There we go. Thank you, Gary. Thanks, Jeff. So now you've put money in that trust. So our life insurance policy is cheap. No, especially permanent life insurance, okay? So bear with me, I'm not suggesting you're going to run out and get excited about buying life insurance, okay? But let's be honest, a permanent policy of life insurance is not cheap. So let's just pretend that the premium, for purposes of this discussion, that the premium was $5,000 or it was $10,000, okay? And so now you gifted that money into that bubble, okay? How many of you have ever heard of Mr. Crummy? All right, there's a man in the back, this gentleman, I've met him several times. All right, and I know some of you have heard about this. So there was a man in the 1960s, his name was Mr. Crummy, and I'm not making that up. And Gary may have known him. No, I'm just teasing. But Gary, how many children did Mr. Crummy have?
I don't remember.
I think it was like he had 17 children and grandchildren. And so, so back then, Uncle Sam said, well, you have an annual exclusion of a certain amount, right? And today's annual exclusion from gift tax is how much? $19,000 per person per year. So Mr. Crummy, whatever it was back then, Mr. Crummy said, well, I have 17 children and grandchildren who are all the beneficiaries of this life insurance trust. I should be able to use my annual exclusion for each one of them. So when I transfer assets into that trust, I should be able to use my annual exclusion amount, which who knows what it was back then. Let's pretend it was $4,000. He just says, I'm going to put that in there for every single one of those 17 people. 17 times whatever that amount was. He says, I should be able to do that tax-free. So the U.S. tax court said, well, we agree with you, as long as the beneficiaries have a present interest.
as long as they have the right to withdraw the money immediately. So Mr. Crummy said, well, wait a minute. But anyway, that gave rise to the new body of law called the Crummy Notice. And so those of you who have heard about this or seen it, we have to give notice to the beneficiaries. So let's say that this trust that you created had 2 children and 2 grandchildren in it as beneficiaries, okay? So now you have 4 beneficiaries. You don't have to use your annual exclusion, but is it a good idea to use your annual exclusion? Yes. So you contribute money to the trust and you have to issue a crummy notice and you have to give them the ability to withdraw the money, usually within 30 days, okay? And then you say at the same time, don't even think about it. Don't even think about withdrawing that money. But do they have a present right? Yes, they have a present right. So it qualifies for the annual exclusion, so you can get money in there. Now let's stop right there. So far, you're buying this policy, you're funding the trust with the premium amount, okay? Now let's say the premium was $10,000 a year, but you had 4 beneficiaries. What's 4 times 19,000? 76,000. So you could actually put $76,000 in that trust, and it only pays $10,000 in premium, because the trustee pays the premium. Now you've got, what, $66,000 into the trust, and you've got it in there, and you've got it out of your estate. Now, each of you has a $15 million exemption, and if you have less than $15 million as a single person, or less than $30 million as a couple, you don't really have to worry too much about this. But how many of you live in Maryland? We have a state estate tax. So you might want to reduce your state taxable estate from estate tax by removing assets from your taxable estate. So if you use an ILET, you can not only buy life insurance that's not going to be included in your taxable estate, but you can remove money from your estate and gift it out of your estate through your annual exclusion if the premium is less than the amount of annual exclusion gifts. So hopefully that makes some sense. So the trustee pays the premium, the life insurance policy is owned by the island. Please stop me at any time if you have questions. All right, now, at the death of the insured, what happens? The life insurance company pays the death benefit, and where does it pay it to? It pays it into the life insurance trust, okay? How many of you have heard of second to die life insurance? All right, so second to die life insurance is pretty powerful, right? It's not always appropriate, but it's cheaper because it's underwritten on 2 people's lives, not just one. So even if you're a married couple and one of you is not in great health, you still might be able to get a fairly, affordable second, so to speak, second to die policy. Okay, so whether it's a single life ILET or a second to die ILET, here we have the death of a insured person. The money goes in there, and now the beneficiaries receive the long-term support of the trust. All right. So why would this matter to you guys? Well, it ensures financial security at the time of death, okay? And again, I want to give due credence to most of you who have done excellent financial planning, and life insurance would not necessarily be on your radar screen. It avoids unnecessary estate tax on life insurance proceeds. So let's talk about that again. Maybe right now you have a life insurance policy, because I know some of you are very diligent with your life insurance. I've met clients that are super diligent. They've paid their premiums all their lives. They've built up cash value in life insurance. And now let's say that you said, well, gosh, I never thought about this life insurance trust thing. I have this policy, and it's not something I'm going to give up, even though my financial advisor may or may not have told me I need to keep it. I'm going to keep this thing. But now I realize that this life insurance policy is countable towards my Maryland taxable estate. Even though I don't have a federal taxable estate, let's say, maybe some of you do, I'm worried about adding this to my Maryland taxable estate. So what you can do is take an existing life insurance policy and you could move it into an irrevocable life insurance trust, and Uncle Sam will say, fine, that's fine, and you have to wait now 3 years, so you have to survive 3 years after you do that. There's a 3-year exclusionary rule that says if I transfer that existing life insurance in there, I've got to wait for 3 years. If I survive for 3 years, now that is not taxable in my estate. So that is a technique. Let's say that you had existing life insurance and you didn't want to wait for 3 years and you wanted to move that into a life insurance trust. Now what can happen is the trust can purchase the life insurance. So there's a way of doing that, and it's kind of a paper shuffle to show that the policy was purchased. So there's a way to get around the 3-year rule. So it creates a structured inheritance. So I apologize, I guess I will go to this whiteboard here real quick. For those of you who could see this. So I should have illustrated this earlier, so I don't know if you can see this or not, but try to imagine this the way I like to illustrate it. Here's the irrevocable life insurance trust. The trust is the owner of the life insurance policy. The trust is the beneficiary of the policy, okay? And the trust has a trustee, obviously. And the trust also has, in my opinion, it has a trust protector. So I think that's a good idea to probably have a trust protector in there. But now, when the insured dies, the life insurance proceeds come into this trust, and they can be held forever. They can be held in perpetuity, if any of you can see that. It can be held in perpetuity, and it's never taxable again. It's never taxable for estate tax purposes in the surviving spouse's estate, and it's not taxable in the children's estate. So I'm not saying that they wouldn't use the money, and obviously you would want your surviving spouse to be able to use the money, but let's pretend that they didn't use it, just didn't need it. It will just continue to grow estate tax free, okay, for a long, long time. So most states have no rule on perpetuities, and so it will just last forever. So that's kind of a visual of what happens with life insurance. Now, some of you might purchase life insurance for several reasons. Maybe you didn't think about this. One of them is to pay for the Maryland estate tax that you might have to incur. Now, there are other ways of planning, right? So let's say we thought, gosh, we're going to have more than $10 million for Maryland estate tax purposes. And we have to look at everything that might count in your estate. So we want to plan for that. There's ways of planning around that in advance because Maryland has no gift tax. So we want to remember that. There's some techniques. But let's pretend that you were anticipating having a Maryland taxable estate. This is a technique that may or may not make sense. You have to look at the policies. You have to look at the premiums. You have to look at the rate of return. Because what you're really doing is you're buying a pot of money. That's what you're buying. And that's going to make sense or it might not make sense, okay? So the first thing I would think about is, do I have a potential Maryland estate tax issue? Now, I'll be the first to admit, I haven't looked at the legislative agenda this year. Have any of you looked at the Maryland legislative agenda? Okay, I have not looked at it yet. But last year, remember, there was discussion about lowering the estate tax exemption to $2 million per person instead of $5 million. So if that happened, right, I know many of you would have a Maryland estate tax issue, right, even with portability. So just want to keep in mind that you can use a life insurance trust. Now, when it comes to time looking at policies, right, you know, many of our great financial advisors are not real experts in life insurance. There are experts that sometimes they bring in. The young man that Jeff and I have run into recently, Max Reamer, who spoke at our client event a couple years ago. Max looks too young to know so much about life insurance, but he is very, very good. And what I'm amazed by, whether it's Max or whether it's Northwestern Mutual or somebody, let's say Mark works with, you know, whoever that is, I am amazed at the difference in premiums. I'm amazed, especially when you look at second to die policies. Sometimes it can be huge differences in annual premiums. So it's really kind of a market, right? It's a marketplace, and it's something to look at. How many of you are, let's just say, you don't have to raise your hands, but let's say that some of you have done a great job with Roth conversion, and others of you, just like many of us, have retirement plans that are traditional, right? Or non-Roth 401ks, non-Roth IRAs, right? Well, now we know our children who are healthy, normal, neurotypical children, are going to inherit those IRAs and have to pay all the tax in 10 years, okay? So you might say, and you might not, because you might just enjoy traveling and not worrying about it. But you might say, hey, I've got a lot of retirement assets that are coming down the pike. And my kids are going to take a huge hit on those retirement assets, And by the time all is said and done, income tax, estate tax, my kids are going to get, 40 or 50 cents on the dollar of these retirement plan assets, and they're going to have to pay all the tax in 10 years. So that could be a reason to think about charging up a life insurance trust to try to offset the cost of what the kids are going to pay in the accelerated income tax of retirement plans. So I'm just giving you a few ideas about that. All right. So we talked about this a little bit too much, but the ILIT removes the life insurance from the IRS taxable estate. What happens today with the crummy notices? The trustee is supposed to send out the crummy notices once a year. And I've met some trustees that are really good. But do most trustees do that? Most trustees don't. So we have to be very careful about that, because even though we have a sleepy IRS right now, the IRS may not always be sleepy. And I can tell you from the Heckerling Conference, on the estate and gift tax side, the IRS seems to be pretty well staffed. But on the income tax side, maybe not so much. So probably not going to get audited, but if the ILIT were ever to get audited, it could be set aside because the formalities of the crummy notices were not respected. And we talked about incidents of ownership. We talked about the 3-year look-back rule. And just to be clear, when you buy a new policy from the get-go, right, and that new policy is purchased correctly and funded correctly into the trust, there is no 3-year period. So the 3-year period is for existing life insurance policies. And of course, it allows for tax-free inheritance for children. And when we say tax-free, we're talking about estate tax-free if it is, properly done, and income tax-free to the recipients. Now, you can make these annual, yearly gifts, and we talked about that, and you can leverage those gifts to try to get money out of your estate if you wanted to. Okay, you don't have to do that, but you could. Now, let's say in our example, because it was, I think, a pretty good example, there were 4 crummy beneficiaries. You funded that, and I'm not saying everybody's jumping for joy to do this, but you put $86,000 in there. 10,000 of it was for the premium. $76,000 stayed in there. Okay, so imagine you put $19,000 per person into that trust. The premium only turns out to be $10,000 or $20,000 or whatever it is. And after the premium is paid, you're building up some significant assets in there. The trust, which is an irrevocable trust, can be, and usually is, a grantor trust. So just think of the grantor trust as many of you have a revocable trust. That's a grantor trust. You continue to pay the tax the way you always did on your Form 1040. Well, when that ILIT, when that irrevocable life insurance trust has that money in there growing. Next year it has more money in there. You're getting money out of your taxable estate. Well, it's invested, right? So this money is invested and it's earning dividends and interest. Well, it's usually, not all the time, but it's most of the time drafted as a grantor trust. So just remember that if you use the ILIT as a gifting tool, it's going to be taxed as a grantor trust, which is generally a very favorable thing, and you will simply put the interest and dividends that it earns on your own tax return. So it does not have to file its own tax return where the income has to be distributed to the beneficiaries. It can be where you, the grantor, can pay the tax. In practice, the beneficiaries rarely withdraw funds, but they could. So you have to have kind of a good faith arrangement with the beneficiaries that you're putting this kind of planning in place for them, and you expect them to kind of respect the nice thing that you're doing by making this money available to them. Now let's say that you funded an islet and you made annual exclusion gifts to that islet, and one of your children or grandchildren makes a withdrawal. You know, they say, I'm exercising my right to withdraw my $19,000. What can you do about that? Because that would be pretty discouraging, right? Well, there would be nothing you could do about it on the first go-around. You would have to give them the $19,000, or the trustee would have to give them the $19,000. But you could limit the amount that they could withdraw the next year. So you could send out a crummy letter, and you could say, well, I'm giving you, now that I gave you the initial $19,000 tax-free, and I asked you not to withdraw it kind of on the side, but you withdrew it anyway, I'm going to make the same gift next year, but you can only withdraw a maximum of $1,000. So you could limit the amount that somebody could withdraw in the future if they were not playing by the rules. So you can fund an islet with cash. You can fund an islet with larger exemption amounts. Okay. Now, is an islet the only kind of trust that can own life insurance? No. So let's say you had a special needs trust that was irrevocable, that could own life insurance. There are other types of trusts that can kind of be life insurance trusts. But generally speaking, if you're specifically going to put life insurance into a trust, we want to design it to be a grantor trust. It's excluded from your taxable estate, and it's designed as an island. The trust can make loans. So let's say that you pumped some serious money, so to speak, into an islet, and you're over here on the side, and you have a spouse that's the trustee, let's say, and you say, hey, what about me? You know, I put all this money in there. It's growing, the income tax, I guess, deferred inside of that trust, and or income tax free, I guess. And I want to take that income out. You know, I've decided that I want to buy a boat or something, you know, and I don't want to disturb my other investments. I just want to take some tax-free money out of this thing. And so first of all, your spouse says, no, I don't think so. I don't like boats. No, I'm just teasing. But you're depending on your spouse to get the money out to you, right? But if they give the money back to you, what are you doing? They're adding money back to your taxable estate, and they're depleting the island. So you can receive a loan, sorry about that. You can receive a loan from the island. And then, of course, there are specific strategies for higher net worth clients. So, of course, there's term insurance, but generally speaking, when we talk about more advanced estate planning with ILETs, we're talking about universal life policies, variable policies, and so forth, whole life policies, and so forth. So, liquidity, let's talk about that. It pays estate taxes without selling property. So let's say that there was a serious amount of money in here. I talked to a client the other day that has a taxable estate, and they've done some pretty good planning. They've already put an islet in place, and if they pass away, there's going to be, $5 or $7 million in this islet. Now, what would the trustee do with that? Well, the trustee would use that money to pay the estate tax, right? So if it turns out on the death of the surviving spouse that there's no estate tax, then this money can be used for various purposes. And if it's not used, it just continues to grow, and it can never be taxed again on the federal estate tax level. It supports a surviving spouse or children or grandchildren. It can equalize inheritances, so we're going to talk about that in a few minutes. How many of you have seen situations where someone passed away and left unequal shares, right? Well, using a life insurance policy can equalize the problem, right? If there's issues equalizing the estate, and equalizing was a goal, you can use life insurance as an equalizer. That's why we say it's the Swiss Army knife. And of course, it can keep planning intact during stressful times after someone dies. I may double repeat myself here, but Uncle Sam gives how long, Gary, to pay estate tax?
recall you have to file within 9 months, and then you have to pay pretty soon after that, otherwise they come after you.
Right. So pretty much, if you don't pay at least estimated tax within 9 months, they're going to hit your estate with penalties and interest. So a lot of people have liquidity problems, and many of you don't. But a lot of people that have a lot of real estate and other things could find themselves in a situation where they owe state or federal estate tax, and they can't get any liquidity. So that's one of the problems that we're trying to talk about here. So how do ILETs protect beneficiaries? Well, it keeps assets from creditors, lawsuits, and divorce. So an ILET would be just like the trust that you may be leaving for your children and grandchildren, if you have trust for them. The ILET would be protected from the claims of creditors because it has a spendthrift provision that basically says the beneficiaries can't assign their interests to a creditor, right? So it's irrevocable. It has the ability to last in perpetuity. It has a spendthrift provision, okay? What else might we want to make it really bulletproof against creditors? Well, we might include an independent trustee. So there could be an independent trustee and not just an interested trustee, okay? So all of these things are kind of going towards the idea of creditors are not going to be able to get into this trust. How many of you know that life insurance itself, even if you didn't use a trust, life insurance is exempt from your creditors? So remember, in most states, life insurance is not subject to the claims of creditors, not that you're going to have them. Life insurance annuities are not subject to the claims of creditors. So life insurance and annuities and IRAs and 401ks are not subject to the claims of creditors. What is one of the things we would want to make sure of in the ILET, in my opinion? That it can only go to descendants, or it can only go to descendants and charities, or it can only go to descendants, charities, and very specific people who are named, like a son-in-law or a daughter-in-law. Why is that really important? Because when we look at long-term effects in the trust, like this trust could last 100 years, it could last 150, 200 years. What happens here is if we limit who the trust can go to, that is called a dynastical trust. And that is what gives us greatly increased asset protection. This is not a general power of appointment. This is a limited power of appointment. So the limited power of appointment is what we want, that it can only go down to certain people, and that gives us asset protection. If we give the beneficiaries of an ILET a general power of appointment, then creditors could actually get into the trust. So we don't want to have a general power of appointment. If you have an older life insurance policy, or if you have an older trust, and I'm sure if you have older documents, Gary has reviewed those, or I have reviewed your documents, but some of the older documents, just as recently as 2010 or 2012, could have general powers of appointment in them. And we want to get rid of those through decanting, because creditors could actually access a trust these days that has a general power of appointment. Okay, so it allows the trustees to support beneficiaries without giving up control. It's a great tool for blended families and vulnerable families. We're almost done, I promise. We're going to take questions and take a break. An ILET can direct funds to a special needs trust. Now, we don't worry about this as much as we used to as far as let's pretend this was a special needs trust, okay? And in the old days, a special needs trust would own life insurance, just like an ILET. It would be an ILET. And why was that? Because the estate tax exemptions were much lower. So we were trying to say, well, if a family needs life insurance for special needs planning, we want to exclude that from the family's estate. But now with the large exemption amounts, except for the Maryland estate tax we have to worry about, we're not necessarily as worried about whether or not in a special needs trust that life insurance is owned in the trust. Life insurance could be owned outside the trust. But if it's owned outside the trust, what does Uncle Sam say? That's taxable in your estate, taxable estate, okay? Now, I'm going to take a digression for just a minute, and we're going to talk about it again when Gary gets up. Yes, Mark?
When do you want me to address the insurance side? When do you want me to
Oh,
address the
whenever you
insurance
want.
side?
You can do it now if you want.
Oh, okay, that's fine. I'm Mark Spiller. I'm the financial advisor for First Command Financial Planning. And, thank you. I'm with First Command Financial Planning, and we support the professional and retired military community with my clients. Some of the things that I think need to be addressed, and Steve said this is the reason I'm holding off to the back of it, because I wanted Steve to make his presentation first. I will tell you, I am a very firm believer in life insurance. I have it on me, I have it on my wife, I have it on my granddaughter. I am making sure that all of them have those dollars available. Why? Simply for the fact that for those of us in this room, the more mature of us, that is over the age of 60, need to consider several things. And when I talk with my clients, the first thing I want to find out is, what is your tax efficient distribution plan for your assets? The second question I ask them is, what is your liability plan in the event that you have a lawsuit for some reason or another? You can be driving down the road, someone can trip on your porch step, you can wind up being sued. And we're seeing more and more of that each day. Gary, you agree with that? Steve?
Oh, definitely.
Yeah.
Yes.
The other thing we're taking a look at, in addition to that, is what is your estate plan? We ask that question. Where do you see yourselves going? Whom do you want to leave your assets to? And how are they supposed to be out there? The other thing we're going to ask you about is, what is your long-term care plan? Is this thing formal or informal? We refer over in our financial planning firm, we say that long-term care is asset protection insurance. For example, I had one of my clients just passed recently who went into a memory care unit here in Arundel County, okay, over in Annapolis. He started at $12,000 a month, then moved on further in the last 5 months of his life in that memory care unit, because of the additional services he needed, was $15,000 a month. So long-term care is an issue. It is a big issue. I will give you a perfect example about long-term care. I've had it for almost 20 years on myself. 3 years ago, and I share this story often with my clients, I was doing some prep work to go on a backpacking trip out to Montana. And I was walking down the bike lane south on Highway 4, because I live in Prince Frederick. A 79-year-old lady hit me from the behind coming off Highway 4 while I was in the bike lane. I laid over here in the trauma center for 3 days, not knowing whether or not I was going to walk again, whether or not I was going to be bedridden, whether or not I was going to have any other problems with recovery. And fortunately, I was carrying a 50-pound rucksack on my back. That's the only thing that saved me. And the law enforcement folks said, we figured she hit me at 40 miles an hour. I went straight up in the air, saw a blue sky, landed right on my back, right on top of my rucksack. Fortunately for me, I only had a compression fracture of the L2 vertebrae. Required no surgery, no rehab. I'm walking, and I'm out walking 5 miles a day. So long-term care insurance is important. It is very, very important if you have not considered it in your financial process. The other thing is, we have to take a look at your survivorship plan. And is what Steve alluded to a minute ago, was second to die policies. Are they in vogue? Is it important for you? It may be, because both of you could be insured on the same policy. In our firm, we deal with the insurance industry such that you can go ahead, take a look at a long-term care built on a whole life chassis that is built as a second to die policy. Now, I would submit, having been a financial advisor for the last 32 years of my life, I will tell you that if your financial advisor is not asking you these questions, then you need to find a different financial advisor. Because as far as I'm concerned, they're not asking you the right questions. And we have to look at it in that whole perspective And we have to, he or she should be harnessing people for you. Folks like estate planning attorneys, for example, folks that sell life insurance. We take a look at the various products out there. Do annuities work? You bet. Are there various types of policies? You don't necessarily have to have whole life. But the real trick in this is please keep in mind that somebody's got to be insurable. If you're not insurable, then you have to look at a different option. And you really need to get with your financial planner and really figure out what that best option is. So they're very hard questions. And I'm as charming as a bulldog on a leash, as Gary can tell you. I don't have any problem throwing it right back at my clients. Well, tell me what you want to do. If you want to be your own financial advisor, then you don't need me. It's a very simple process. So please ask those hard questions to your advisor. Because I've worked with Steve, I've worked with Gary for a number of years now, and clients that I have all have confidence in the team we have together at First Command, and when I bring Steve and Gary into the equation. So just keep that in mind.
Thank you, Mark.
Does that
Thank
answer
you so
your
much.
question,
No,
Steve?
that's very nice. And I think what I'm taking away, among other things, from Mark's comments, is that he's a proponent of life insurance, and a lot of financial advisors are. But I do think a lot of financial advisors kind of are so into money management, which is fine, and everybody's entitled to different priorities. But I just think that you should give due credence to the life insurance strategy. So thank you, Mark, for those comments. And as we wrap up, before we take a break, remember someone asked me the other day, I have several trusts for my kids. How can I turbocharge so I can leave a bigger legacy? So you can use life insurance for that. And I promise we'll get to our break. I'm not going to spend a lot of time on this. So here's a case study very quickly. The family owned multiple properties with little cash. They funded an islet with life insurance. It prevented a forced sale of the property, and so the 9-month to 16-month period after someone dies, when the taxes are owed, it prevented a forced sale, and the children inherited the properties as intended. So life insurance is a tool. Here's the example with the adult with disabilities example. And again, I said this at the beginning when I talked about heckling, and I'll say it later when Gary's talking as well. There's an increasing concern that even special needs children who are eligible for public programs, those programs were just not going to be able to deliver. And we as attorneys and financial advisors and parents and grandparents, we need to increasingly think in terms of private funding. How can we fund these trusts so that kids, these young adults or older adults with disabilities, will have caregiving at decent payable rates where there actually won't be a shortage of caregivers. So the islet would be a great tool for a special needs child, or the islet idea. And as we wrap up, here's a family that owns a business. In a case right now where 2 siblings inherited money from parents who were very successful, and one of the siblings gets the business, and the other sibling does not get the business. But they did not realize at the time of the death of the surviving parent that the business would be worth a fortune. So there's a disparity in how much the 2 children are getting, and life insurance, if there was planning in advance, life insurance could help a situation where there was a child not being treated equally due to a business. So ILETs offer protection, liquidity, and efficiency. They have unique benefits for the right person. It's worth looking at if there are issues. ILETs are ideal for families with long-term goals, and it's a powerful solution in many circumstances. And in some circumstances, it doesn't make any sense, as Mark was saying. Premiums might not be reasonable, you might not be insured, but it is something to keep in mind that is a tool in estate planning. All right, we're going to turn it over to Jeff and Gary. Are we taking a break, gentlemen?
Can I ask a question?
Yes, sir.
This goes back a while, but you said that the Island Trust would have a trust protector. I've never heard that term before.
Well, thank you. The question is, what is a trust protector? And Maryland officially adopted the trust protector idea in 2014. And Maryland calls it a trust advisor. So nationally, this is known as a trust protector instead of a trust advisor. but it's a special fiduciary, and I'll explain where this comes from, that has limited powers. Now, some of these are big powers. They generally have the power to remove and replace trustees, and they have the power to amend. They have the power to amend a trust administratively. So this is kind of a shocking idea if you've never heard of it. So a trust protector came about in the law from states like Delaware, Alaska, South Dakota, Nevada, Wyoming. What are those states? Those are asset protection states where you can do super planning to protect assets. So it came from those states, but there was a recognition somewhere around 2005 to 2014 that we have millions of irrevocable trusts. And these millions of trusts can't be changed, even though the world is changing, even though circumstances are changing. So there should be a way, most people think this is a good idea, not everybody, there should be a way to tweak those trusts. There should be a way to have flexibility in those trusts without having to go to a court. So you can say, I'm leaving a trust for somebody, and I'm naming a trust protector, and that trust protector will give my beneficiary flexibility. If the trust needs to be amended because Congress changed the tax laws, the trust protector can make basic amendments. And if there's a bad trustee, the trust protector can remove him. And another subject for another day, if my child is serving as the trustee and they don't have asset protection that's quite what I would like it to be as the sole trustee of the trust, because when a child is serving as trustee, they don't necessarily have the same level of asset protection as if an independent person was serving. So let's pretend that your child got sued or divorced and you had left a trust. Well, it would not be ideal for that child to be the trustee during that divorce or during that problem. So the trust protector would replace that trustee with an independent trustee. So the trust protector has to serve in a fiduciary capacity, and it does take a little bit of getting used to that this tool exists. But we kind of think that for most people, a trust protector is essential. Who has any other questions? And we'll take a break if you don't. Yes, sir.
You mentioned if you make a contribution that's greater than the premium, if you make a contribution that's greater than the premium and there's some money left over, and I didn't quite understand how that gets taxed.
All right, that's a great question. So you could use the ILIT to just shelter the life insurance proceeds from your taxable estate. You could just do that. You could pay the premium, and that's it, right? And when you put your premium in there, you're making a gift, right? And because you're making a gift, you can use your annual exclusion, right? So you don't have to use any of your estate tax exemption. You can just use your annual exclusion. So let's pretend you said, hey, this is a great thing. I've got 2 or 3 or 4 beneficiaries of this thing. I can use 2 or 3 or 4 crummy, annual exclusion amounts. So now I funded it more than the premium. So I'm getting money out of my estate. Now that's going to be taxed as a grantor trust. So those dividends and interest, let's say it earned, $24,000 of interest or whatever. That $24,000, unless you said otherwise, that $24,000, you would pay that income tax on your own tax return. So as a grant, so think of it as, like your revocable trust is a grantor trust. So the IRS says when you make irrevocable trusts, you can play around with the rules. IRC 671 through 678 is the grantor trust rules. And to make a long story short, it's wealthier people can manipulate the tax code. That's what it means. So you can say, I would like to pay the income tax on that rather than the beneficiaries. And that's how you do that. All right, let's take it. That's a great question. Thank you. Jeff, are we taking 5 minutes? 5-minute break. Thank you, everybody. Get your lunch if you haven't gotten it yet.
So if I take away the wealthier
Okay, we're going to get started again. And before we get get started, I just wanted to recognize who has become a client care program member in the last year. All right, look at these hands we have. Welcome. Welcome. Hi, Andrea. Hi, John. All right. Gary?
Need to go over those 5 things?
Yeah, before we start, Mark wanted me to just elucidate a point that he made, and then we can start the next session, okay?
I can go over those 5 questions you need to be talking to your financial advisor. If you want to write these, just smarter with the equipment. How's that? All right. If you want to write these 5 things that you want to talk to your financial advisor, please ask you a question. What is your tax efficient distribution plan? You want to make a note of that. He should be asking you that question. What is your tax efficient distribution plan? Number 2, what is your liability plan in the event you get sued? One of those considerations may be an umbrella policy if you don't have it to protect your assets. The third thing is the long-term care plan. Third is long-term care. Fourth is your survivorship plan in the event we lose someone too soon. You go before your wife goes before the husband, whomever, right? And then the last thing we need to take a look at is what is the estate plan. So those are the 5 that you should be talking with your advisor, at least your advisor should be asking you those questions when you meet with him or her at your annual financial review. And I would further recommend that at least once a year you meet with your financial advisor and go over each one of these, because there may be changes that need to be made to those various plans that you have. Okay? Any questions on that? Okay. Hopefully this has been helpful for you.
Thank you, Mark. I'm sure we don't have questions right now, but Mark will be here afterwards.
No, I just wanted you to repeat the first one.
Tax efficient distribution plan.
All right, everybody. We're going to do something a little bit different next. We've been doing this for how many years together now, Steve? Too long. All right. And we try to bring in guest speakers. We provide new concepts of the law ourselves. But the next, how much time do we have? About 40 minutes, is you all are going to teach us. So what I have found in my practice, and Steve has found as well, is sometimes clients come to us and they have a problem. And the problem is they're not quite sure that the best thing in their own family situation is to leave assets in even shares to their children. I've had this come up a lot, Steve, I know you've had it as well. So what we're going to do this morning is we're going to have 3 case studies, 3 different fact situations. And what we're going to do is open up the floor to you all. So Jeff, do you have one of these things? And there are 1 or 2 more around. Does anybody else have one of these portable?
I have one right here.
Okay, so here we go. I thought we were going. What button do I push here to go on? Got it. Wait a minute. You have it? This is it? One more. So use this. Let's use that here. This here, okay. Yeah. All right, so imagine clients come to our office. Husband and wife come to our office. They are married. They have 3 children, Manny, Mo, and Jack. I got to tell you, when I was telling my wife what we were going to do this morning, I told her that the original names I wanted to use were Bo, Larry, and Curly, but she told me to grow up, so. Okay? They have retained an attorney to design their living trust. They have advised their attorney about their family dynamics. We have 3 case studies this morning. In case number 2, Jack is severely disabled. But in case numbers 1 and 3, all 3 children are married with children. They live within an hour's drive of their parents. Their attorney has asked them how they would like to design the distribution pattern of the assets to their children when the surviving spouse dies. Husband and wife are conflicted. What I'd like for you to do is consider the following 3 cases. And what we're going to do is, Steve and I are going to talk less, you all are going to talk more. So here we go. Case number 1. Yeah, I did it, great. Manny and Mo and their spouses keep in constant contact with husband and wife. They gladly attend family functions and assist husband and wife, often without being asked. They visit husband and wife as often as possible. They remember and acknowledge husbands and wives' birthdays, anniversaries, and other important family dates. They make every effort to have husband and wife see the grandchildren as often as possible. They invite husband and wife to all special events of the grandchildren, birthday parties, school functions, holidays, and everything else. Jack only contacts husband and wife when he wants help, whether financial or otherwise. He makes a good living, but spends beyond his means. He has a sense of entitlement. You've heard the term bean counter. He's a bean counter. He rarely makes the effort to visit husband and wife, rarely attends family functions, rarely invites husband and wife to his family functions, and rarely makes the grandchildren available to them. Jack has little time for husband and wife. Husband and wife are saddened by this and have difficulty coping with it. Jack's wife is not the driving force of this dynamic, but is also detached from husband and wife. She has time and interest only for her family. They come to my office, they come to Steve's office. You are the clients. What we would like to find out is, what are your thoughts? What would you decide? What are some of the factors? Anybody? Somebody has to raise their hand, otherwise we're going to be out of here very early. All right? Anybody have an idea? Any thoughts? Yes, sir. Hold on.
Well, you could be vindictive about Jack and try to reduce what he would get out of the estate or the trust. Or you can just say, well, he's just a different child and lump him in with the other two, as a prodigal son kind of thing. But it depends on how strongly the parents feel about Jack's reticence of being, part of the family.
That's a good point. I know that the natural instinct, I think, is to treat children equally. But sometimes there's something inside of you that says you'd rather not do that. So, Gary?
I think the thing I would be more concerned about is after you die, how the distribution will affect the dynamics among the 3 children.
Yeah. Hold on. Oh, you have it? Yeah. All right, go right ahead. Sorry.
One thing would be to mentally partition the assets into those are first generation and those are for grandchildren. And to treat the grandchildren equally, so that the pass-through to the second generation satisfies a sense of fairness, but the pass-through to the first generation is more limited and unequal at a level of not necessarily total exclusion, but something that is proportionate or that reflects perhaps the level of shared interests.
Yeah, that's a good point. I know in some of my cases, I've had a situation similar to this, and the parents wanted to make 3 equal distributions, but for the child that they're sort of disappointed in, they leave a portion of that child's share to that child's children. Is that what you were talking about?
Yes, but so that the grandchildren across families receive comparable, each child comparable assets in whatever form, whether it's school tuitions or it's assets, but that, so a portion of the estate, a substantial portion of the estate, if it's large enough, is passed to the second generation rather than the first.
That's interesting. Yes, hold on.
think the other thing to consider is that while you may want to treat Jack differently, you may not want to treat his kids differently, and feel like you ought to treat the grandchildren basically the same and not put them in a difficult situation because of how Jack and his wife are dealing with things.
Gary, I was looking at this example here, and it presupposes, I think, that the parents have given a lot of financial gifts to Jack. Is that part of the scenario?
They do with great hesitation and conflict.
I got you.
Yeah. Anybody else? I will tell you, I've had many clients come to me and for whatever reason tell me that for this particular purpose, they don't want to make an even distribution, but they also are conflicted about what will happen after they pass away. Will it cause any type of conflict among the 3 children? So if you're a client of mine and you've had this situation, you've probably heard me say something like this: do what you want, do what you think is right, you will not be around to hear the complaining. So any thoughts on this first situation? Because it happens more frequently than you would think.
Gary, I had a comment. Maybe it's applicable, maybe it isn't. But in this case, we might assume that there's been substantial gifts, and maybe the parents want to equalize, or make an equitable adjustment of shares to the other children. And then, in my mind, there's the issue of whether the parents have the ability to do that. In other words, is there enough money to make an equitable adjustment of the shares, however the shares are going to be split between the other 2 children? And if they don't have enough money, they could use, I'm just throwing out the life insurance again, they could use life insurance as an adjustment tool.
So that's a good thought, and here's my response to that. If you are making gifts to one of the children and not to the other 2, have you told the other 2 children about it? Yeah. I would be inclined to think that more often than not, if you're making gifts to one child and not the others, you probably did not tell the others. Okay? And if that's the case and you try to equalize things later, again, this is not a legal issue. It's more of an internal issue. How would you process that? So now let's assume, in your situation, that you were making gifts to one of the children and you wanted to do it. But obviously you don't want the others to know, because all of a sudden, instead of making 1 gift, you're making 3, and you're really trying to provide for a child who's somewhat less fortunate. Would you tell the other 2 children toward the end, here's why I'm giving more to child number 1, who was that, Manny, and not so much Mo and Jack? And if you did that, what kind of pushback might there be then? So it's not an easy thing.
Gary, I would argue, and others might be thinking about whether they have comments or not, but I would argue that now you've raised the specter of another problem. It made perfect sense, it emotionally made perfect sense to make this decision, whether to adjust the shares or not, or leave more to one child than the other. But now we have the issue of what? The child who's disaffected could raise an objection, right? And now we have, will contests and trust contests. So I think that raises the issue of what we talked about a few CCP meetings ago. We talked about using enhanced no contest clauses and things like that. So I think there are things on the back end that this raises.
One of the provisions that attorneys will often put into their trusts, if there's some type of an unequal distribution, or if one child is being disinherited at all, is language in the trust that acknowledges the child. And a statement that you are leaving the child out, it was done voluntarily and knowingly without any fraud or duress. Because these provisions that Steve is talking about, where if you, a no contest clause, they're called ad terrorem clauses. And basically, for the most part, they're not enforced. The only real grounds that I'm aware of where they'll be enforced, at least in Maryland, if there is actually a good faith reason. Keep in mind, a child does not have an automatic right to a birthright. Parents can do what they want. So it's not like a surviving spouse who has what we call an elective share in Maryland. In Maryland, you cannot legally disinherit a surviving spouse. a surviving spouse is entitled to the greater of what is ever left of him or her in the deceased spouse's estate plan, or 1/3. And under this new law we have in Maryland called the augmented estate laws, this applies not only to trust assets or estate assets, but life insurance policies and retirement plans. But a child has no inherent right to inherit from their folks. Any other thoughts on case number 1?
Just one other thing, Gary, not to drag us all into the weeds, because we'll come back out, I promise. But another thing is...
I have a weedy ear.
All right. So real quickly, choice of law. Okay, so we're living in a world, you heard me say earlier, multi-jurisdictional world, multi-jurisdictional practice. How could that apply to us, doing our everyday estate planning? Well, this might be one of those applicable points. We include a much more robust no contest clause, and we say, oh, well, gosh, Maryland doesn't enforce these no contest clauses. You can actually choose where the administration of your trust should be. You could actually look at states that have more enforcement of the no contest clauses if that was important to you, and you could choose that jurisdiction.
All right, so let me follow up on that. First of all, are you aware of states which are more inclined to honor these clauses in the wills or trusts?
Yeah, I don't have it in front of me, but there are states that treat this differently in certain circumstances.
So these ad valorem clauses usually say that if anybody contests what's in the will of the trust, then they're not entitled to receive anything. I'm not sure how good that is if the person who's contesting it is entitled to nothing anyway. All right, so let's go on to case number 2. Very different, and this is what Steve was talking about earlier. Manny and Mo are healthy. They are loving children with whom husband and wife are totally happy. They are self-sufficient and modestly comfortable and happily married with healthy young children. Jack has severe physical and mental disabilities due to an injury he sustained in an automobile accident when he was a teenager. He will never be able to work or be self-sufficient. He will be forever dependent upon government benefits and support from husband and wife. Jack never married and has no children. And here's the kicker. Husband and wife want to provide for Jack, but also know that as their grandchildren get older, this would be the children of Manny and Mo, as the grandchildren get older, their parents may not have enough set aside to assist them with college or trade school expenses. Here's a situation where one child won't be able to work through no fault of his own. The other 2 children are modest, but are not wealthy as well. It's a difficult situation. Any thoughts?
Well, I think it's absolutely necessary that Jack is left with enough money or help with whatever type of a trust that's needed for his care. But at the same time, 529 plans, those kind of things can be set up to provide for the other children. And then it depends, like some of the other ones, how much money do these people have to prepare for things. But I don't know what special needs trusts are or how they can grow, but I think that would be a priority.
But I'll tell you what, Steve, you spoke about them earlier. Would you like to elucidate on exactly what a special needs trust is? Steve, by the way, is one of the experts in the state about these things.
Well, a special needs trust is a discretionary trust versus a trust you might leave for your neurotypical child for their health, education, maintenance, and support. So anytime you see the S word, support, that tells you that's not good for a special needs child who is receiving means-tested public benefits like SSI or Medicaid or a waiver program. So if they have a discretionary trust, and the best kind of discretionary trust is the kind where you as a parent or grandparent would create the trust as part of your planning, and that is called a third-party trust. But when you think about it, that's very confusing. Like, what's a third-party trust? Well, a third-party trust is the same kind of trust that you're leaving right now to a child or grandchild if you're leaving them a trust. That's a third-party trust. You are the third party leaving an asset to somebody else in trust. Because the way the law works, If you leave a third-party trust with somebody, they have asset protection, divorce protection, creditor protection, all those things if you leave it in the right way. But now, if you leave a third-party trust that just happens to be a discretionary trust under Maryland law, that is a special needs trust. So the third-party supplemental or special needs trust is the kind you would establish for a person like this. And at that person's death someday, there's no payback to the state of Maryland. The second variety is called a first-party trust. Some of you know what this is in the audience. And that just means that a person with disabilities received money that they probably shouldn't have received. It knocks them off of their benefits, and they have to get rid of it. So the states, since 1993, say there's a way to leave that money in a trust where the Attorney General approves it. The Attorney General approves it, and they approve every one of them. And if the person's under 65, they can leave it into a certain kind of special needs trust. That is a payback trust, but it does keep the person from being disqualified. If the person's over 65, they have to use a pooled trust, P-O-O-L-D, pooled trust, and that is a group trust, not just a single trust. So there's two or three types of first-party trust, but the main trust you're going to be concerned about. Mark mentioned the military and First Command and all the clients he has in the military. If you are a military veteran and you have a pension, you can assign your pension to a first-party special needs trust, and that's been the Pension Protection Act of 2015 or something like that. That's a fairly new law. So the third-party supplemental needs trust is what this fellow would have been best for him. If his parents died and left him the money outright, that can still be dealt with. It's just not as efficient.
Thanks, Steve. So let's see if I can just break this down. Most of you have trusts for the benefit of your husband or wife if you're not married, and the language in that trust says that the assets in the trust will be used for the health, education, or maintenance of the other. That's a support trust. And when you have that kind of a trust, the beneficiary, if he or she thinks that he or she is not getting that benefit, she can actually go to court and ask the judge to review how much distributions are being made, whether or not she's getting the health, education, or maintenance that is reasonable. A support trust, the kind with a special needs child, the trustee has the absolute discretion to pay zero to that child for his or her entire life. Totally discretionary. So the beneficiary, the disabled child, would not have a right to go to court and say, hey, wait a minute, this trust was established for my benefit, I'm not getting any benefit. The trustee can choose not to provide any assets at all. It sounds harsh, but that's the only kind of trust that would qualify for these needs-based government benefits. Because if a child's receiving SSI or Medicaid, the law says that he or she cannot have any assets of his or her own, nor can there be a trust that can be enforceable to support them. So a trust for a special needs child is one in which a trustee has absolute and total discretion to distribute all of it in the same day, or zero for his or her entire life. It's a different kind of a trust. And I think Gary, you were talking about the trust protector. If you're a client of mine and you're married, you'll find the language generally of a trust protector in Article 16 of the trust I prepared for you. If you're single, you'll see language of a trust protector in Article 13 of the trust that you have, okay? All right, any other thoughts on this example? Yes, hold on.
It might be more comfortable, it might be comforting to the parents if there's a provision in the special needs trust that any residue would pass back to the family where the funds are more limited. So that because someone with severe physical or mental disabilities, but particularly physical disabilities, may not have the physical stamina to survive as long as one would like. And the question about, well, then can the provision for the residue at least return to the family as sort of an act of faith, I think, to the parents who may or may not be able to even with a 529 plan, may not be able to provide the education that they want.
And that's a very good thought, and generally in these types of trusts for special needs children, there is a provision that says that upon the death of the special needs beneficiary, if there are any assets that remain, here's where we want those assets to be distributed. Usually to the other children, or maybe to other beneficiaries, but generally in those types of trusts, there are provisions which say that upon the death of the special needs child, to the extent there are assets that remain, is where those assets will be distributed. Any other thoughts on case number 2? All right, so let's go to case
I
number
just had one thought, I'm sorry, and I know you're trying to finish on time, and we will finish on time. But I think this is that situation which many people in the audience have seen or experienced themselves, where, for example, yesterday I was in a meeting where parents were sitting in the conference room. Their wonderful son was on the Zoom call, and he's going to be the trustee for the Special Needs Trust for his sister. And he's, they're openly saying to him, we're not leaving you anything. We're leaving everything to her. And he's acquiescing to that. He's a great guy. But that's not always the case, right? And many people know, situations where there's a sibling who's, they're not always going to step up and be that sibling who's going to take care of their special needs sibling, So if you have that kind of sibling or child in your family, you're very blessed. And then some people don't have that, but and that's an example of yesterday. So there's a big disparity there in how the assets are going to be left.
And here's the thought. Remember in this example, the husband and wife don't have a lot of money. This is a perfect example where a second to die policy on husband and wife may be the best thing to do, because again, as Mark explained earlier, the premiums for a second to die policy or a survivor policy will probably be less than you would expect because you're insuring the lives of both husband and wife. So even if one of the husbands or wife, either the husband or wife has some kind of a health problem, because you are actually insuring both lives, it may be more reasonable than you thought. The next example I think is the hardest one to deal with. So Manny, Mo, and Jack are all great children. They treat husband and wife respectfully and in a loving manner. All three are married with children. This is a very happy family with an enviable family dynamic. Everyone gets along with everyone else. Family functions, holiday celebrations, sound like your family? And special events of the grandchildren are all attended by everyone. There is no friction among husband and wife, children, daughters-in-law, sons-in-law, grandchildren, etc. Manny and Mo are successful and live comfortably. Manny is a colonel in the U.S. Air Force. His wife works part-time as a paralegal. Mo is an engineer. His wife is a career federal employee. Jack works in sales for an auto parts supply company that makes a very modest living. He has had other jobs, but they similarly did not pay him much. His wife is unable to work because of a medical condition. Because of Jack's precarious financial situation, husband and wife are concerned about his long-term financial security. His situation is not due to a lack of effort. He simply never achieved the long-term financial stability that his brothers have. Husband and wife love all three children the same, but are conflicted about how to design their estate plan. They have always treated their children equally, but are concerned about Jack's situation. They are also concerned about possible resentment of Manny and Mo if they were to find out later that Jack inherits more than they would. And of course, when the time comes, they'll find that out. They treasure their family harmony, but are very concerned about Jack. So, here's a situation when all the kids are great. Two of them have done very well. One of them simply has not. And please, for this discussion, ignore what I said earlier about you won't be around to hear the complaining. Let's figure out what would be the right thing to do this time. Any thoughts?
I think that you can help the child who is not doing as well during their lifetime, so that the issue of an even distribution of assets upon death can be even, and you can, if you're able you can put money in the child's retirement account while you're alive, and that can make it, upon death, have an even distribution, possibly.
So that's a good idea. You mind if I ask a follow-up question?
Sure.
All right. So first, correct me to make sure I've got what you're saying accurately. Are you suggesting that while mom and dad are alive, they help Jack along the way? And that might be a way for them to, in their own minds, figure that things are balanced out by giving. Okay. So here's my question. As the parents are giving Jack some help while they're alive, would you think it's a good or not so good idea to let the other two brothers know that these gifts are being made? That's a hard question, by the way.
Yeah, I think you could let the other brothers know.
Okay. She says yes, she thinks so.
You wouldn't?
Let me give you the, I'm gonna give you the microphone and not ask you a single question.
You know, so much depends on the dynamics. And one of the comments I wanted to make about your entire presentation is that the 3 children are all male. Because in typical relationships, daughters have a closer relationship than necessarily sons. Not always, but in many cases. We all have secrets in our lives, things that we may share with our spouses, hopefully all that we would share with our spouses. But there are things that you don't share with your children, ever. And I think that decisions that we make as husbands and wives vis-a-vis our children during their lives, that's our decision. That's our private decision. And although in an ideal world, you can just let everyone know about everything and everybody's going to be fine with it, I would say that eliminating any strife, potential strife during your lifetime, when you say you're not going to be around to hear the complaining, you don't want to be here to hear the complaining right now. So I would say that is why I would not let them know.
Interesting.
Actually, since the family, they all get together quite harmonious, I actually sit down with Manny and Mo and talk to them about it and get their thoughts and have them help you make a decision as to what you want to do. Whether you include Jack, it's another question, but it seems to me that if they care about each other, including Jack, that they may also feel a way to deal with it, and having their input could be very beneficial to preventing strife in the future.
That's pretty good. Yeah, I like that.
I thought so.
Do I know you?
Oh, Manny.
And we're, by the way, in deference to Gary, we're going to change the dynamic, the family, to Manny, Mo, and Jane. Okay. Gary, for this one, I believe that just give it to everybody equally. So this is an opportunity for, what is his name, Jack, to maybe this is his financial hub, but you don't need to necessarily take care of him by buying everything for him, but you are providing for him. So similar situation to this that I was in, my parents had the trust, had all that. Now there is certain things that you may look at who the trustee is, and they have other knowledge just by being there as one of the child or one of the children. That may not be, they just know. But if they each get equal parts, or equal, whatever that is, then that's still helping Jack, even though the other two may be a little better off. But that's one of the ways that you can not have that strife. And as you said, there's certain things that you do not tell your kids, certain things that you do as a parent that are there to try to help your kids or otherwise. But that's just my 2 cents on this. This is one of the ones. The other two, you had certain things, especially one where the disabled child, you definitely have to take care of that. That's something that this one is they may be doing better, others may be doing better, but they're, to me, this is more of a equal situation than anything else. I know I'm ranting on. I'll stop. Thank you.
My comment is just from a situation of a friend recently. Her son and wife are, let's see, his wife is a career federal employee. She lost her job. That changes a lot.
It does. I will say, we'll bring the microphone right down. You raise your hand, I think. Yeah, I just want to make one comment, actually one observation, and that is, I have a lifelong friend who I spoke with about a month ago. He had 3 children, 2 are very successful, the other one is just not. And he asked me, what are your thoughts? And I said, Charlie, what are your thoughts? And his thoughts were this: when they were young, they had different needs, and I would help the child who needs help from me the most, and I wouldn't feel compelled to write a check to the other 2 to equalize the extra help I made to them. And I'm their father, and I feel it's my responsibility to do the right thing. And if one of my children needs my help and the others don't, I'm going to give it to them. And that's what his feeling was. Case closed. I'm not saying it's right or wrong. I'm saying that was a point that he made, and I knew at some point this morning I want to tell you what his thoughts were. So I think.
This is a bit along the same line, I suppose. I'm struck by the fact that Jack's wife has a debilitating medical condition. This is in its sense a special need that the others do not have. And it seems to me that this offers the parents the opportunity to contribute in kind. For example, by paying health insurance fees so that the insurance can be at a level that's tolerable for the family, that kind of specific purpose might well be ratified by the other children if they knew about it. Secondly, that apropos, the things you should never say to your children, and there are some of those, I'm sure, of course. It's also possible sometimes to say that we are providing some additional help to deal with her decreasing capacity without ever specifying what it is or how much it is or whatever, and thereby make the other 2 children aware. But they probably are aware anyway if it's a close-knit family, but without giving specifics. A completely different alternative to that is to say, ultimately, yeah, we would like to give essentially equally, but one child has needs now that the others do not have. So we'd like to provide more now with the child, with Jack's knowledge that it's more important right now than later to have the assets, and keep the partitioning then simpler, juggling the 2 things, but just saying we're going to switch up the timing.
Let me follow up with that. Would your analysis be any different if Jack were not married and had no children, so it's just him?
Probably. I think the debilitating medical condition it really hard, in my mind, saying, okay, now you've got less income and you've got heavy expenses, and they're gonna get worse. How do you help with that? And would not the rest of the family, as they're described here, agree that those things are important to do? Remove that, and then I think it changes.
Thank you very much.
Just one side item is Lorraine's situation with someone I know. If you do, whether when you're alive or when you die, you have to really talk it over with the, say, Jack, because he may be receiving government help, and if you throw that in with a parent and gives you money, could lose a lot of government help. And the spouse, if right now I understand if they have a problem, the spouse, and the spouse has any money, like a person who gets Alzheimer's, in the end, this person I know can't qualify for anything because of her spouse. And they don't have a whole lot of money, but because of his, she doesn't qualify for anything. And this is in the state of California, which has a lot of benefits.
There's no way of doing it right as far as I'm concerned, and there's no way of doing it wrong. But I think talking and being open and being honest and really, really wrestling and finding a way to come to peace with it is the most important thing of all. And so I guess that's what I would suggest for this family, is find some way to come to peace, because nothing will stay the same. Somebody will get sick, somebody will have something happen.
You said a very wise thing, which is, in the end, it's really up to the client. It really is. And the comment I made earlier today, when we first started, was ultimately it's your decision. I mean, when I've had these types of conflicts in families, and they've asked me, should I talk to the children about it? My usual knee-jerk reaction is no. Because if you end up letting them into the decision-making process, and you end up doing something different, it might have made the situation even worse.
Mm-hmm.
Anybody else have any thoughts?
Just to follow up, in this type of situation, please alert your financial advisor if any of this is on the horizon for you, because it's going to affect your overall financial security, planned and unplanned. So please make sure that your financial advisor knows about this well ahead of time and bring it to his or her attention.
Thank you. So Jeff, I think we've got to 12 noon. We promised we would get you out on time. We know that you'll have some other things to do later on this evening. So Jeff, I'm going to defer to you.
Let's give Stephen Gary a hand. Thank you so much. Also, Mark, thank you for your comments as well. So please have a safe drive back. We will see you again soon. I think we're going to have our actual first quarter event towards the end of March, beginning of April, and then followed by an early summer event before y'all go down to Florida or